Right now, as we speak, Datavault IA, ticker symbol DVLT, is trading at exactly $1.78. That represents a significant intraday push to the upside of 18 cents, translating to a raw gain of 11.56% on the session so far. If you are watching the order book live, you are likely seeing a flurry of green prints hitting the tape, creating a level of volatility that demands serious attention. This isn't just a standard drift. This is a concentrated move that suggests liquidity is rushing back into the microcap AI sector, specifically targeting companies that are pivoting from pure software plays into tangible asset infrastructure. When you look at the chart, the stock opened aggressively, dipped briefly to test support near the 165 mark, and has since reclaimed the upper band of its daily range, sitting right now at 178. The volume is outpacing the 10-day average, which tells us that this isn't just retail traders chasing a momentum scanner. There is likely some algorithmic accumulation happening in the background. The expectation for a stock trading under $2 with AI in its name is usually one of extreme skepticism, and rightfully so. Most investors, perhaps even you, look at a ticker like DVLT and expect it to be a vaporware company, a business with a flashy website, a few buzzwords about machine learning, and absolutely no revenue to back it up. You expect it to be a classic pump-and-dump candidate that surges on a press release and collapses by lunch. That is the standard playbook for the speculative end of the NASDAQ. However, the reality of Datavault IA is significantly more complex and frankly more interesting than the typical penny stock narrative suggests. The reality here is that Datavault isn't just trying to build another chatbot or a generative image tool. They are positioning themselves as the plumbing for the next iteration of the digital economy, specifically focusing on real-world asset tokenization and data valuation. While the market expects a flimsy software wrapper, the reality is that this company is securing contracts to digitize massive industrial assets like geothermal energy reserves, which fundamentally changes the valuation model from hope to contractual revenue. This discrepancy between the vaporware expectation and the infrastructure reality is exactly where the opportunity and the risk lies. Let's look closer at the specific market mechanics driving this 11% move today. If you are tracking this on your Fidelity mobile app, you might just see the percentage gain, but you need to understand the flow behind it. The stock is reacting to a digestion period following its massive revenue guidance update and the announcement of the Triton Geothermal deal. When a company of this size suddenly projects revenue jumping from under $10 million to potentially $200 million by 2026, the market breaks. Algorithms that are programmed to scan for growth anomalies immediately flag the ticker. This creates a feedback loop where momentum traders on Robinhood app platforms see the movement and pile in, while institutional algorithms on interactive brokers trading platforms attempt to front-run the trend. The price action at 178 is a battleground. The bears are arguing that the guidance is too aggressive and the cash burn is too high, which we will discuss shortly. But the bulls are arguing that if the company hits even half of that $200 million target, the stock is fundamentally mispriced at these levels. It is crucial to understand that Datavault is trading in a sector that is currently highly sensitive to interest rates and liquidity. When you look at NVIDIA stock, you see the ceiling of the AI trade, the massive trillion-dollar infrastructure play. But Datavault sits at the opposite end of the spectrum. It is the speculative, high-beta play on the application of that infrastructure. Unlike Apple stock, which is a fortress of cash and stability, DVLT is a speedboat in a hurricane. It can maneuver quickly, but it can also capsize. This volatility is why you see such stark differences in how different demographics trade it. A younger investor using Robinhood crypto accounts might view DVLT as a proxy for the blockchain narrative, given the company's heavy focus on tokenization. In contrast, a more conservative investor using Fidelity Wealth Management Services would likely look at the balance sheet, see the net losses, and stay far away until profitability is proven. Both perspectives have merit, but today's price action suggests the market is currently favoring the growth at all costs narrative. Let's strip away the hype and look at the actual business, because this is where things get dense. Datavault isn't just one thing. It operates with a dual-engine model. On one side, you have the Acoustic Science division, which deals with WiSA technology, wireless spatial audio. This is tangible tech, licensing hardware and software for high-definition sound. It's a steady, albeit slower-growing part of the business. On the other side, and the real reason the stock is moving today, is the Data Science division. This is where the concept of the data vault comes in. The company has patented technologies that allow them to attach a value to data and, more importantly, to physical assets. Think about the geothermal deal they just signed. They aren't drilling for energy, they are digitizing the value of that energy so it can be traded, tracked, and monetized. They are essentially trying to turn data into a currency. When you consider online investing, you are usually presented with a menu of standardized options. Stocks, bonds, maybe some ETFs. But the vision Datavault is selling is that in the future, everything will be an investable asset. They want to be the exchange for that. If a company wants to sell a fraction of its future revenue stream, or a fraction of a gold mine, or a fraction of a patent portfolio, they need a technological layer to verify that asset and track it. Datavault claims to be that layer. This is why they use terms like data quarterback. It's a bold claim for a small company, but the recent contracts suggest they're getting traction. The Triton Geothermal deal alone involves up to $8 million in fees and a percentage of future transaction fees. For a company of this size, that is non-trivial revenue. It validates the technology in a way that a simple press release about a partnership never could. Now, I want you to pause for a second and think about your own portfolio. Whether you're managing it yourself via SoFi Active Investing or just watching from the sidelines, you have to ask yourself, what is your exposure to the infrastructure of value? Most people have exposure to the creators of value, like big tech, but few have exposure to the companies trying to rewrite how value is measured. Comment below how many shares of Datavault IA you currently hold, or if you are waiting for a pullback to the 150 level before entering. I'm curious to see if you guys are chasing this breakout or playing it safe. Let's address the risks, because they are substantial. Expectations are high, but the financial reality is gritty. The company has historically burned a significant amount of cash. When you look at the fundamentals on a Fidelity brokerage research page, you will see deep red ink on the net income line. They have been spending heavily to acquire these patents and build out the platform. The recent capital raise and the revenue from the licensing deals are a lifeline, but they are not a guarantee of permanent safety. Dilution is the enemy of the shareholder in this bracket. If the company needs to raise more capital to fund that growth to $200 million, they might issue more shares, which dilutes the value of the shares you hold. This is the classic growth trap. The company gets bigger, but your slice of the pie gets smaller. You need to be watching the share count closely. If you are using Schwab Intelligent Portfolios or similar automated tools, they often filter out stocks with this kind of risk profile, and for good reason. This is an active trader stock, not a set-and-forget savings account. However, the counter-argument, the bull case that is driving this price to 178, is that the leverage is exponential. If their platform becomes the standard for RWA tokenization, the margins on that software licensing are massive. Software has low variable costs. Once you build the platform, onboarding the next $1 billion of assets costs you very little, but you keep collecting the fees. This is the same model that made Visa and MasterCard giants. They don't own the money, they just own the rails it moves on. Datavault wants to be the rails for data and asset tokenization. If they succeed, the current share price is a fraction of its potential value. If they fail, it goes to zero. That is the binary outcome you are trading. We also need to consider the macro environment. We are in a period where liquidity is starting to look for alpha outside of the Magnificent Seven. Tesla stock had its run, Nvidia stock had its run, money often rotates. It flows from the mega caps down to the mid caps and eventually into the micro caps. If we see a risk-on environment continue through the end of 2025, stocks like DVLT are the primary beneficiaries. Traders on Robinhood cash management accounts who are looking for high volatility will gravitate here. Furthermore, the regulatory environment for crypto and tokenization is becoming clearer. As governments establish rules for digital assets, companies that are compliant first, which Datavault claims to be, have a moat. They aren't trying to dodge the law, they are trying to build the tools to comply with it. Let's analyze the institutional footprint. Historically, microcaps are dominated by retail, but recent filings show some interesting activity. You have smaller funds and quantitative shops starting to nibble. When you see activity on interactive brokers' platform data feeds showing block trades, orders of 10,000 or 50,000 shares at a time, that is not usually a